Okay, so we're going to do a quick video here on how is it that every time you want to do a trade, you enter the trade, within 30 seconds of you entering the trade, it's met all your criteria, it looks good, it's going to go either up or down, buy or sell, and sure enough, it goes against you and you get whacked or you get stopped out, and then when you get stopped out, it turns around and goes back the other way. Well, there's two things. It's the man, and he's fixing the books. He's cooking the books. It's seriously, I mean, you know, the amount that we trade, we're just retail traders, day traders. You know, I mean, some guys have big books, but, you know, we're buying 1,000, 2,000 shares, maybe 5 or 10,000 in these stocks, and not big size. And so there's nobody out there. I have done a video on this before, actually. There is nobody out there looking at your specific trade. One of the things that does happen in the brokerage firms, so the brokers, the top brass in the brokerage firms, they can see all the trades. They know who's underwater, who's got trouble, who's got big positions that are margined. And they'll trade against those guys. They'll short the stock, drive it down, and then the guy's got a margin, guy or girl's got a margin call. They've got to sell the position out. They cover their shorts. That does happen, and that happens all the time. But that doesn't happen to us. We trade too small. We're just small traders. But how is it though that the instant that you make a trade, it goes against you? How can that be possible? Well, there's a guy named Murphy. He wrote some laws, and that's one of his laws, that sure enough, within 30 seconds of placing a trade, the stock will go against you. Why does that happen? How does that work? Well, here's what the problem is, or this is my theory on it. Let's just take I&O for an instant as a case, for instance, not an instant, for instance, for a case. Let's say you're watching it did pull back. Well, yeah, I mean, you could see here it double top, so you know you're not buying that. You thought it might break out here and pull back, you're waiting, it does spike down, but it comes back, reverses, holds support. And then you see that it's in this wedge. It's holding support here at the 1340. And you think, okay, I'm going to take that trade. I'm going to hold support. Well, in a case like this, what happens quite often, you see it spikes down. Market makers need position. They may be getting a bunch of orders coming into the market, which they see, or they've got a call from an institution that wants to take a big position. So they'll whack it down. They'll force all the stops out, and they'll collect the paper up, and then they'll put in their order, and away they go. That's one of the reasons you sometimes get stopped out. If you're buying it on a support level and you get these big spikes down like that, it's because two things happen. One, market makers need paper, so they knock it down to try and collect some up. Or two, guys or girls with big books and the ability to get big short positions, borrow them, they take a run at these stocks because they know that people at certain levels, people have tried, they're buying the stock, they're holding it, and they're waiting for a breakout. Like, for instance, here, let's just say stock spiked up through this level here, and it looked like it's going to go, and it fails, or it starts to go, but then what happens is, and so you buy the breakout, think this is going, and it's great, it pops, and it looks like it's going to go, and then all of a sudden, kaboom, it gets whacked. Because what happens is they know that the retailers they know that this is a breakout, and they know that a certain percentage of the population buys the breakouts. And so when it goes through it, one of two things is going to happen. So then they take a run at it. So the guys with big short position, or that have ability with big books, that whack a stock, and there may be half a dozen of them, they might be on the phones to each other. Okay, let's give it. and they whack it. Sure enough, all the people that bought the breakout, all of a sudden they're underwater. They have to sell. They panic, and then of course they're selling, and it just feeds on itself, and then down it goes, carries on down lower. So that's one of the reasons why the instant you buy a stock that it goes down is because now half the time it goes up. Why? Because the guys might take a run at it, but when they do take a run at it, like say maybe here they took a run at it, or these areas in here, it looked like it had broken out here, pulled back, broke out through, and so maybe they tried to short it, and they're shorting it in here, but it's not going down, and then all of a sudden somebody with big books that maybe have a big short position, or they see this action, they go long, they say, okay, I'm going to squeeze these shorts, and they burst into the market, kaboom, off it goes, and everybody chases it. Not only do the shorts chase it, but the retail buyers that buy the breakout chase it. So half the time it goes up, half the time it goes down. Half the time it goes down is because the people that are selling or shorting the stock, maybe this is their ABC, where they sell half at the breakout, so they're selling, the shorts pile in and knock it down. But in this case, they couldn't knock it down. Now these guys have got big short positions, and somebody knows that, and they go against it the other way. They buy all the stock, and kaboom, off they go. I mean, the stock traded 192 million. Traded 192 million. This is the kind of stock a guy can buy 100,000 shares or sell 100,000 and have liquidity to cover, or to get off his position as it goes up. This is the trader's dream, this kind of stock, this big a float, this kind of volume, and this kind of price action. It doesn't come along very often, but in this case it has, and now it's feeding on itself. So just to reiterate that, if you find that you're buying stocks and the instant you buy it, it goes against you, it's because you're buying it as a retail trader, and along with all the other retail traders, the smaller ones, because you've learned certain patterns, and the pros know that, and then they just, so as soon as, because you're not the only one that sees the pattern, because that's all we're trading is patterns. And the pattern that you see may be one of two things. It might be a well-recognized patterns, but it doesn't have the volume, or the shorts have decided to gang up on it, number one. Or number two, the pattern you saw actually wasn't a pattern, and therefore it just goes against you, because it wasn't a valid pattern. It wasn't something that you should have been trading in the first place. So I hope that sheds some light on it.